Okay, we're gonna stop talking trash. So y'all know when y'all go to U-Haul and you like you know you're moving and you got to get like a box truck and they'll be asking if you got no CDL license, if you ever did this before. They just give you the keys and let you drive. This is my moment. I never did this before, so y'all bear with me. But I have these two lovely guests. Small Business Week has brought together two of Birmingham's best and finest in venture capital investing and early startup investing. So I want to introduce Nate Schmidt of Techstars and Medved Kendrick of Generator. So I want you guys to take a second to introduce yourself and let them know how cool you are.
Oh, of course, throw it into me. I'm Medved Kendrick. As Rae'Mah said, I am a senior managing director at Generator, which is a national accelerator platform. We've been running accelerators across the country for about a decade. We have 4 here in Alabama now, or 15 programs, 4 different partnerships that we work with. And in those, we work with early stage startups, helping them connect with mentors and investors, which we're here to talk about today, as well as we directly invest in a handful of those companies through 3 investment accelerators across the state. In my role, I directly run one of those programs, the Bronze Valley Investment Accelerator, as well as oversee several of our programs across the South as the senior managing director. Before that, I was in economic development, specifically workforce development in tech, and before that in academia. So kind of a circuitous route into this space, and so I'm still new and learning a lot, getting the keys at the U-Haul without knowing how to drive it as well, but have learned a lot and really enjoyed getting in this space.
I love it.
Yeah, Nate Schmidt. I have been in Birmingham for 22 years now. I married into the South after meeting my Birmingham-born wife in London when I was in law school there. I've had a 22-year run of being a tech entrepreneur. I've had a variety of outcomes from good to bad, and welcome. And now I'm investing in startups, and so I am, or I was investing in startups. I'm with Techstars. We're a big investor for very early stage tech companies. I was the managing director of the Techstars Energy Tech Accelerator, which invests in energy tech and clean tech companies. And now I have changed roles in Techstars. I now manage many of our accelerators up the East Coast. But I have a lot of experience investing in startups, running startups, and figuring out the highs and lows of this crazy entrepreneurial journey that we're all on.
I love it. Okay, so we got some whole experts in here, so thank you guys so much for coming. And just for everyone knows, we'll be discussing like building relationships with investors, discussing about asking for venture capital, how much to ask, not asking for too little. And we've got this lovely panel to kind of give us some advice here. So I kind of want to hop in and talk about small business owners. They have a special place in my heart because my mom was a small business owner. And I noticed that many of them fund their business like with bank loans, business credit cards, their personal credit cards, which are not the good, not very, good resources to fund your business. And I think most of them are scared about venture capital because they think if they exchange equity for VC money, they're like giving their company away or losing autonomy. So can you speak on why founders shouldn't be scared to go up to venture capital?
I'll maybe hot take and say maybe they should be cautious about going into a venture capital relationship. And a lot of the different resources that you mentioned in terms of bank loans, their own cash, those are all great ways to fund your business. And the first thing I encourage companies to do is what are all of those different resources in terms of funding your business that you could access. Venture capital is a space that is very specifically focused on early stage startups with high growth potential. And the reason people pursue venture capital is usually because those opportunities are not available. They can't get a bank loan because they don't have collateral. They don't have 2 years of bank statements. They've just started. They don't have enough cash in liquid cash themselves or their credit cards to fund, and they're not generating revenue, so they can't fund their businesses in those ways.
Yeah.
So that is why someone might choose the venture capital path. When you do take that path, you are giving up ownership in your company and control and all of those things you mentioned, so it is something not to take lightly, but it is a very valuable source of funding to get your business off the ground if these other resources are not available to you, and you fit the specific things that our investors are looking for, which I'm sure we're going to get into. But it is definitely something I encourage companies not to look at is, here's some way to get money and help me, get this piece of equipment or whatever it is. But there's a very specific type of investment that investors are looking for in the venture capital space that is on a rapid growth trajectory, and they do take ownership of and want to see that to be successful. So I'll pause there, and I will get more into that.
Yeah, I think what I would add to that is, if you start a new business, especially if you start a tech company, it's inherently really risky. Not anything to do with you. Like, it's just statistically a very risky thing to do. And so, what I want to see people avoid when they become entrepreneurs, I mean, being an entrepreneur is really lonely, right? And you may have left a job and you're at your house and your apartment, and you're sitting there alone starting this new business. One thing you need to realize is, like, every big business you see when you go outside started as a very small business. Those businesses are inherently really risky, and one thing I don't want you to do is to put yourself personally at a ton of risk. And so the question becomes, who are all the different people that can support you on your journey of entrepreneurship? And venture capital firms are ways up the chain, but what money is available? What grants are available? What programs here in the city are available to help your business get launched? And to launch it in such a way that you're not putting a bunch of money on a credit card that could personally bankrupt you if the business doesn't work out. And so what are the different, opportunities you have for money? And yes, at the very earliest stages, that might include credit cards, it might include your own money, but I want to get you away from that as soon as possible. Go find investor money, whether it's angel investors, whether it's institutional investors, whether at some point it's venture capitalists. The good news is, if you lose their money, you don't lose your, everything you have in the world, which is an important thing to kind of keep in mind, I think.
Yes, I definitely agree. So just to recap there, be wise, be very intentional if you're going and you're seeking venture capital. Like Haley said, it is very, very risky. And so sometimes you may want to bootstrap it as long as you can before you approach a VC's doors. And I do agree with Nate, though. Like, don't put yourself in a position where you're running up your credit cards and losing houses and homes and tearing up relationships as well, trying to also bootstrap as well. So, all right, y'all. I'm a little bit nervous, so y'all is going to have to bear with me.
Come on, Rae'Mah.
But the next thing I kind of wanted to touch on is, I think sometimes small business owners specifically go to, like, their personal credit card and business credit cards and bank loans because they know what failure looks like, right? If you default on a loan, they'll go on your credit. If you don't pay off your credit card, or, when you have credit cards, you know how to finagle the system on paying the minimum here, the minimum there. And so they kind of get used to this balancing act, and they're very confident in that. So I think VC looks scary because they don't know what failure looks like in venture capital. So have you guys ever had an investment that failed? And what does that look like for a founder?
Yeah, absolutely. So I now work for Techstars, a big venture capital firm. Techstars invested in me in 2010. And so they invested, the Techstars investment is $120,000. And then ultimately, the people that were in charge of Techstars had a fund, and they invested a total of $500,000 in my company in 2010. I lost all their money. And it feels bad. In fact, it still hurts. And in venture, I'm now on the side where I'm making the investments. And when you make the investments, you know that most of those are going to fail. And I can say to you, hey, like, statistically, it's probably going to fail. But you still will emotionally, like, entrepreneurs are unreasonable people, right? Like, just going on the journey alone is kind of an unreasonable thing to do. You never think it's going to be you. You're like, yeah, no, I know it's risky. And then your thing fails. And then it's like you can feel defeated and broken because of it. I still remember when I went to my Techstars investors and I was like, hey, and 5 years later, I was like, bad news. And you always know, I've now had people do this in reverse, like, Nate, can we talk? I always know what's coming. Hey, I lost your money. Telling someone you lost $500,000 of their money is one of the most heart-wrenching things you can do, because so much of your life is, like, put into that business. My investors were like, we knew that 3 years ago. Don't worry about it. It's fine. Because they understood the risk. But for me, I almost didn't apply to Techstars because I lost their money and felt like they would hate me because I lost their money back in the day. And I still feel like I still lose sleep over the fact, like, I'll never get over the fact that I lost $500,000 of somebody else's money. They're cool with it, but I'm not.
Yeah.
And I think to Nate's point with the level of risk in this industry is he mentioned the statistics. He can imagine, or they could imagine that he may have failed. 9 out of 10 is the commonly cited statistic of 9 out of 10 startups fail, early stage startups fail. And so investors realize going into these conversations, venture capital investors, that 9 of these 10 companies that I've invested in are not going to make it. So when they get that call, I got an email this week of a company that we invested in saying that they were closing the doors. You probably saw the writing on the wall with particular companies, and again, just statistically, it's expected. The other side of that coin is then they expect every one of those 10 that they invest in at the time they invest to be able to pay back for all the other 9 that fail. And so in terms of the type of value proposition that you're taking to an investor when you're asking for money, it's understanding that they expect for you to be able to pay off the entire 10 investments that they make, because every other one is going to fail. They think at the time they're making the investment that you could be the one that doesn't, or they wouldn't be investing in you. But if you can't make that argument that you can pay back what maybe 100 times what they invest in you, then it's really hard to get past that first conversation and be an attractive investment for a venture capitalist, because they are making those type of trade-offs, knowing the high failure rate. I will say a couple of the specific tactical or operational things that I think are murky for folks that are not familiar with this industry. When you say, hey, all the money's gone, if you're in that position, there isn't a issue where your house would be taken from you, or any of your other things that you own, or you go bankrupt or have to do any of that, because investors understand this risk. Again, they know that a lot are going to fail, and you're not personally responsible for paying back any of those loans affecting your credit and these sort of things. Again, when investors are looking for who are the people that I want to bet on and make investments in, a lot of times they're looking for people who have done this before. And so, as counterintuitive as it sounds, having an L on your sheet of where you've tried it and failed before, it can be a really attractive thing to investors, because they know, okay, this person ideally has learned from this journey. They've seen what the process of running a startup is like, what it is like to raise money, and they are back at it and doing this really challenging thing again. And so being able to, I think that's something that a lot of us talk a lot about and think about, is how do we become more comfortable and celebratory about failure, because it is incredibly defeating personally, but it is a really valuable experience to going into that next venture, and investors like to see that track record.
I'm so glad you touched on that, because that was actually going to be my follow-up question, is what are the financial repercussions when you do make that call, when you do announce to your VCA, we ain't gonna make it. And so I'm really glad that you covered that, because I think sometimes it's like you said, Nate, it's hard to fathom losing $500,000 or any amount of money, especially if you don't come from wealth. So I really appreciate you for covering that, Haley. So I kind of want to bring it back a little bit. We kind of skipped to failure, and that's on my part. So I want to back it up as to what it looks like getting in touch with you guys and going after VC money, which starts with pitching. And so for people that have never done this before, and there is no manual book, unfortunately, what tips would you give?
Yeah, so the seat I sit in is very specific in an accelerator. I know Nate has been in that role as well, where there is a very set path to receive investment through most accelerators, which includes the application process, interviews, and going through a very scheduled engagement to be selected into a very competitive number of seats that then usually have a pretty standard term of investment based on that program. More broadly, with early stage investors across the board, it really varies each person you talk to. Some will have very clear public instructions on their website about how you might apply or request a meeting, and some will make it nearly impossible to find any contact information whatsoever, and everything in between. I would say at the end of the day, everyone making these investment decisions are people that want to do business with someone that they enjoy talking to and trust, and especially when they're giving them money, the trust in a relationship, that knowing that you're going to be able to execute on what you said you're going to do is the most important. So before you ever are, trying to put together your pitch deck and getting in front of them to click through some slides, I would work on building a relationship. What does it look like to connect with that person at events, take them coffee, exchange some emails, sharing some things that you've seen about the other investments they make, and ask questions. It's infinitely easier to ask for a meeting if that person knows you and has already decided that they trust you and want to see you succeed than someone they've never heard of before.
And here's a tough one to get past. At the very earliest of stages, the investors don't really care about your idea. So armed with that information, you should spend the least amount of time actually talking about your idea. And that's a mistake that entrepreneurs make. They talk to an investor and all they want to do is talk about this magic of this idea that they have. We all have ideas. We all have ideas all the time. When I look at a very early stage investment, I'm looking at the person. Is this person a builder? Is there any reason to believe that they might be able to build the thing that they're talking about? If it's a tech company, do they know how to, write code? And if they don't know how to write code, do they have a plan for how they do that? Do they have anybody else in the business with them? Do they have a co-founder, and do they have a unique set of skills? And just why did they do the business? It's the mistake that we make is not talking about the why very much. And it's extremely important to go explain to your investors, there's a million things you can do with your life, and you have decided to take this path toward this one idea. Why? Why did you choose that idea? Why are you the best person in the world to bring that idea to market? What skills do you have that are going to make it more likely that you're going to be successful? So spend time talking about yourself, which we're all uncomfortable doing, or most of us are uncomfortable about doing. Talk about yourself. Talk about why you're doing the business. Talk about who's going along for the ride with you. It's all that stuff that's ultimately going to give you the investment, not because you just happen to come up with the world's most magical idea. I always use the example here in Birmingham. Ship, it's on the building downtown. It's grocery delivery. Bill came, and I remember once I was listening to him speak, and he's like, hey, I'm going to do grocery delivery. Instacart's done grocery delivery. Lots of people have done grocery delivery, but he was exactly the right person to execute on that business in a way that was really meaningful, and he cared about it for the reasons he cared. He was happy to articulate that to you. But, it's not the idea that's usually the magic. It's the person behind the idea and all the things they're going to do to make that business work that really, can make it go.
Ooh, that was a gem, because rapport is really, really valuable in building those relationships. And I think when you find out someone's an investor, it's so easy to become very schmoozy. Oh my God, I just have this idea. And so, yeah, we do kind of skip over wanting to connect with you as a person. So I think that is great advice. So what common mistakes, when you guys finally do get to the pitch, you finally got the meeting set on your calendar, what common mistakes do you see founders make when they're actually pitching you, when they're actually going through the slide deck?
You can maybe start all these.
Drop it,
Yeah.
y'all. Yeah.
Investors are going to ask you some questions that seem simple, and they are really hard. Hey, what does your business do? They will ask you that. I can't tell you how many times I meet with someone, they explain to me what their business is, and afterwards I have no idea. Explaining your business in a concise way is surprisingly difficult. How much money do you need? You want to trip up an entrepreneur, ask them how much money they need. Oh, $500,000. Wait, $2 million. Which is it? Is it $500,000 or is it $2 million, right? What are you going to do with the money? You can trip people up there too, I'm going to hire some developers. You have to go into those conversations with a plan, who you are, why you're the right person, how much money you need, what you're going to do with the money. And those are the types of questions that if you can start to answer them, you might have to have some success. But they seem relatively simple, but you see people screw these answers up again and again and again. And it's the worst feeling in the world to be talking to an investor. And that's what they do. They invest in companies, and they start to ask you questions that in your mind seem extremely simple. What are you going to do with the money? And you start to trip over your own words. That's a horrible feeling. And then I'd say the final mistake that I see is at some point you're going to have to ask for money. And I've had entrepreneurs come to me before, and I'm like, oh, they were like, that meeting went great with the investor. I'm like, cool. And I think they're going to invest. I'm like, well, are they or not? They're going to invest? No, they're going to invest. How much are they going to invest? I don't know. They might invest $50K, $100K. They don't even know how much the person's going to invest, right? And so you at some point, and to Haley's, to what Haley said, you have to build rapport and talk to them and establish like a relationship with these investors. But at some point, you have to look them in the eye. You have to be like, okay, I kind of have you pegged for writing me a check for $250,000, and I'm now asking you, will you write me a check for $250,000? Like, it needs to be that explicit. And if you don't ask, you're never going to know the answer to the question. And at some point, you have to ask. And saying big numbers out loud is terrifying if you haven't done it before, like really hard. And typically, the investor that you're talking to, there's no number you can say that's going to scare them. And that's a hard one to get past too. So yeah, those are some mistakes I've seen for sure.
Ooh, that is good. That is really, really good. Really, really good. Okay, so that actually leads me to my next question, because the thing is, sometimes, especially as a serial people pleaser, that was me in a former life, you think asking for a really low amount is going to just come off appealing to the investor. Like, if I just ask for like really, really low, like just give me $50K, but I really need $500,000. But let me ask for $100K, but I really need like $1 million. What actually goes into y'all's mind when you see a founder that probably has like a great idea and they ask for an obviously too little of an amount?
I think the more important thing in those conversations is the founder entrepreneur knowing what to expect out of the investor. They've essentially done their research of, I know the type of companies that this investor invests in. I know the typical check size that they write. I think what is less off-putting to me is a founder coming to me and saying, hey, I see you do this range. I'm raising this total amount, maybe $1 million, but I know that you invest $100,000 to $200,000. We're talking to these other investors as well, versus coming to a conversation, hey, I'm looking for $5 million, and knowing that is well outside the range of what our team invests. And so knowing that you've done your research and you're not just kind of one size fits all of your conversations. And then beyond that, once you've done your research and know what the investors are, how they approach investments, what they're looking for in terms of their outcomes, their ownership stake, the things they want, knowing to Nate's point, how much you need and what you're going to spend it on. I think a lot of people see this company raised about this much and that sounds good at this stage, so I'm going to throw that out there, but really knowing this is the amount that I need to accomplish these specific goals. And so I want to know that they have goals and outcomes in mind, and the money they're asking for is helping them get there. I would encourage founders to ask for as little as they need, especially at the early stages, because that's when they're going to be giving up the most ownership in their company. And so if they don't need $1 million, I say don't ask for $1 million. If it's only $100,000 that you need, then ask for that. Make sure it's enough. Make sure you can accomplish the goals you're saying you're going to accomplish with that. But don't inflate it just to have a bigger number, because it is ultimately ownership of your company you're giving up. And getting into, when you're raising future rounds of capital, it can set you up to have a harder hill to climb if you raise too much too soon.
That's a good point.
You see, it's a really tough line to kind of tightrope walk, which is, hey, I'm going to build the next Facebook. Okay, I'm going to need $50,000. I'm like, I think you're probably going to need a lot more than $50,000 to build the next Facebook. Is the amount of money you're asking for a reasonable amount of money given the goals that you have? And given how fast you're willing to go as a human being? Something that I always do, and I have new startup ideas all the time. I will fire up a spreadsheet and I will put, it's May 1st. I'll put May, June, July up at the top, and I'll go about 24 months into the future, and I don't have an MBA. I'll try to just really think through how much money I need to make this business work. And I think of it like a video game. Like, how much money do I need to defeat the first boss? Then how much more money am I going to need to defeat the second boss? And do it in your terms. Don't get worried about like that you have to have this perfect pro forma that an accountant would look at and sign off on. Just get a spreadsheet out, get a piece of paper out. Really think through, if you're going to go as fast as you can go and you had an unlimited amount of money, how fast could you truly go? How much money could you really spend with your own limits as a human being and your own knowledge as a human being to build a business? But that's what I'll go through. I'll think, if I had an unlimited amount of money, what's the thing I would go build if I was going to go as fast as I could? And how much money do I need to kind of get over that first hurdle? And whatever that is, if I think I need $100,000 to get over that first hurdle, then I might go to investors and be like, hey, investors, I need $100,000. Except I'd probably ask for $200,000, because it's always worse than you think it's going to be, and it always takes longer. But model it out if a startup founder ever comes to me and hands me a piece of paper that's like all their handwritten notes showing how much money they need, and I can tell they've done the work to try to figure it out, that's a really good indicator to me. Unless they stand up and say, hey, sit down and say, hey, I need $50,000 to build the next Facebook. So imagine you had all the money in the world, model it out in your own terms, and show your work. Show your work to the investors.
And no matter what you model out, there are going to be things that you get wrong, and everyone knows that. But knowing that you've thought about it and consider these different implications of different decisions you may make, or if things go well, we'll hit this number. If not, we'll need more money or more time. And so, more importantly, is the showing your work piece of I've been really thoughtful about how much I need and why, and I can defend those instead of just saying, oh, that sounds about right with what I've seen.
Good deal, good deal. So look, know the goals, know the intention that you have, and then for Nate, ask what you need. Ask what you need. If you need $2 million, don't ask for 500,000. And that's actually a lesson that I learned from Nate. So I appreciate you for that. So I want to kind of go on to setting up your cap table. So when you take investment, ultimately these people go onto your cap table. And sometimes you shouldn't always say yes to the investment. It's so interesting because you get so many no's, and then you finally get to the yes, and you're like, oh, I can't even accept that yes. So can you two speak to when you should maybe say no to an investor that is offering you money, and then also any tips on setting up your cap table, what you should look for in the investors looking to invest?
Sure. So the work I do, primarily with Bronze Valley, we have a very specific thesis, which is focused on founders of color and female founders, and there tends to be an impact focus in that work. For that alignment, we have very specific things we're looking for in founding teams, but also in terms of the goals that you have as a company and what you're trying to accomplish. You want someone on your cap table that is aligned on those goals and believes that the goals that you have chosen are the ones that you should attack, unless you're willing to change those. If they do invest in you and are on your cap table, that's a relationship that you should expect to last for at a minimum 10 years. So this is not a quick transaction that you then move forward from, or have a loose mail relationship that you might have with your bank. It is going to be, oftentimes they will take a board seat. They will expect regular communication with very detailed information about your business at some interval, usually at least quarterly. And they do own a portion of your company. So if their goals and yours are not aligned, you're going to be in for a headache. So however you identify that, obviously they're going to be asking you a ton of questions as they evaluate you for investment. You should ask the same of them. I think it's totally fair to ask other investments they've made if you can talk to the founders of those companies and get their feedback. You can hear a lot from other folks in the same world, whether that's regionally or in a particular industry. It's a small world, and again, back to relationships. People talk and know one another, and so you can learn some that way. And ultimately, do you like and want to work with them? At the end of the day, you're not necessarily going to have to spend all your time with them and sit next to them in the office. But when you do have a unfortunate call where you might have to tell them, listen, I'm going to need a lot more money than I thought sooner, and I need you to stick your neck out for me, is that a call you can make with that person? Something else I'll add is when you're looking at different types of investors, so maybe a venture capital fund and an angel investor, they can have very different expectations and levels of experience with those sort of things, and knowing what those are and the different people that may be both investing at the same time and how they're going to interact with one another. One thing I see from time to time is folks that have a friend or family member or a local partner that comes in as an angel investor and wants to be really involved, which can be helpful if they have industry expertise or some other really valuable knowledge. But they may have expectations to be more involved than even your venture capital investor, your institutional investor, and they may have given you $10,000 and the VC gives you $100,000, and so the weight of their feedback should be somewhat aligned there. And so if their expectations are not in line with the level of commitment that they've made, maybe that's financial, maybe that's other things, but that can cause a sticky situation down the road when you go to raise more money, or your other investors have conflicts with those already invested.
Yeah, I would say one surprising thing about cap table. So cap table, who owns what in the company? Who owns however many shares? The thing I care about is cap tables aren't broken. And here's what I mean by that. It would be surprising here. So tech companies start off with a couple of people and a few computers. They're not that expensive to start, and they can potentially become multi-billion-dollar companies. And it's that allure is why venture capitalists are potentially investing in your companies. But let's say you're out there getting your first amount of capital for your tech startup, and let's say you need $200,000. And you came to me and you said, Nate, I'm going to need $200,000 for an investment. How much do you think of my company I'm going to have to give up for this? I'd be like, I don't know, 15 or 20%. If you came to me that same day and said, Nate, I need $2 million for this startup. How much of my company do you think I'm going to give up? I'd be like, I don't know, 15 or 20%. In the early stages of tech investing, the amount you give up of your company has no bearing on reality to how much your company is actually worth. The goal is that we're setting you up for success in the future. And so what's typical is every time you raise money, you kind of give up 15 to 20% of your company. You could raise $100 million 3 years down the line because your company's going really well. You might give up 15 to 20% of your company. And so what happens is, and a mistake that I see made is very early on, your company's not worth anything. You're just getting started. You go to a friend, you go to a family member, they give you $50,000, they invest $50,000, and you give them half your company. Your company is now broken forever unless you undo that. Because then if you go to venture capitalists later, you've got someone who's not really working in the company, not particularly sophisticated about the business, that owns half the company, and like you're uninvestable at that point. And so the key with your cap table in my mind is putting the right people on it, yes, but making sure that they have a reasonable amount of ownership depending on kind of the stage you're at in your company. That's a huge mistake that we see again and again. And we have companies that we want to invest in that have a broken cap table, and we straight up have to turn them away and tell them we cannot invest in them. And not only can we not invest in you, but it's a hard thing to hear that, like, we're not going to invest in you. And oh, by the way, probably no one will ever invest in you again because you did this wrong. You're going to have to go undo it. Very painful moment for an entrepreneur.
Can you talk a little bit more on the undoing of it and what advice you give to someone trying to undo it?
You have to undo it. I mean, so let's imagine, and this happens more times than I can tell you. Let's say you have someone on your cap table that, the example I gave, they gave you $50,000, they own half the business. You then go back to them and you say, hey, you shouldn't have had half the business. How does 8% sound? And they're like, wait a second, I own 50% of the company and you're suggesting what? I'm suggesting you go to 8%. Like, why in the world, if I own 50%, would I go to 8%? Oh, because venture capitalists are telling me that I can never raise money again if you don't do that. And they're like, screw that. I'm not going to go down to 8%. Who are these venture capitalists anyway? Like, then a fight kicks in. And those fights are painful. And a lot of times the founders cannot convince the shareholders just don't believe it. They're like, oh, I don't know who these venture capitalists are, but they're wrong. No, they're right in this case. Like, you own too much of the company. And it's undoing it is, once that you agree to undo it, then it's just, the lawyers undo it. It's not very difficult. There's not a lot of legal work to undo it, but simply getting someone to say they'll undo it's the challenge.
Got it.
Let me ask you, would a cash offer to buy back that share help sometimes?
Yeah, sure. I mean, sometimes the new investors will come in and some of that money will go to buy that person out. But, a lot of times that person doesn't want to be bought out. And a lot of times you don't have the money to buy them out. And then you're going to the investors and you're saying, hey, invest in me. And I'm not going to put that money to work in the business. I'm just going to use it to go pay people where I made poor business decisions in the past. Oh, don't worry, I'm going to make good business decisions with your money in the future. It's like you go down this rabbit hole of difficult decision making. And it's hard to go convince an investor to come in and just like use the investment money on buying out somebody in the company that you shouldn't have let in for that number anyway. It's a tough situation.
So what would be, I guess, the correct start of knowing exactly how much to give someone in your company based on how much they give you? Like, how much should you set aside for venture capital if you know that you already have one investor?
Well, every time you raise money in a startup scenario, and a restaurant is different, a retail store is different. So there's lots of different types of entrepreneurship that are all valid and wonderful. And so we're mostly talking about tech right now. But every single time you raise money, you're going to give, like I said, 10, 15, 20, 25% of the company, maybe not 50, and not usually 2. But the nice thing is every time you go raise money again, which is totally okay, everybody dilutes. And so you're not the only one taking the hit. So let's say you own 100% of the company, and then you sell 20% of the company to an investor. Now you own 80, and the investors own 20, and then you do it again, right? You sell 20 more percent of the company to the next round of investors. Well, those 20% owners the first time around and you will both dilute. And so you're not going to lose 20% the second time around. You're going to lose 16%, which is 80% times 20%. So every single time you raise money, all of the investors take the hit. And so it's not always on your back every single time. Did that answer your question? I mean, it wasn't exactly your question, but I felt like it's where you were going.
And it can be challenging to find sometimes, but I think plenty of people in this room and that support this type of work can help you find what did other companies like you give up at the stage that they were at that you are now. And so if Nate's company raised $1 million when they had $20,000 in monthly revenue, and they gave up 15 to 20%, I can expect that if I'm making the same amount of revenue and I'm raising the same amount, that might be a reasonable amount for me to give up at that stage, depending on what the market was like then and now, because it's very different. But that it can be tricky to find, but that being armed with that information when you go into those conversations, one, helps show the investor that you know what you're talking about and gives you an idea of what to expect, just like I wouldn't sell my car not knowing what cars like mine were selling for in the area. I'd, do some internet stalking and look at Kelley Blue Book or whatever. But if I were to go in on either side of the equation and say, I'm going to sell this for $500 or $50,000, whoever sees my ad for my car is going to be like, that's a joke. This person's an idiot. And I'm not going into that negotiation with a strong position. So knowing what the comparables are out there really helps you navigate some of that.
That's really good advice. Having a template, looking at companies before you, especially ones where you would like to grow to their stage. I think that's really good advice. Yeah.
Do you have a question?
Yeah, I do. How can you gauge the seriousness of an investor? So, for example, at what point as an entrepreneur should you just walk away from a deal that you feel like it's going on for too long and the investor hasn't really shown any serious signs of closing? I had an investor, I actually sent him a term sheet, and, he sent me on all these hikes in the park, and, we did all this stuff. Building a relationship, it was good stuff. But the deal didn't close, and so, as valuable as it was, I just felt like I wasted my time as an entrepreneur. So at what point do you kind of...
Here's the thing about investors. They need you as much or maybe more than you need them. Right. They have to make investments. And investors, a lot of times, doesn't just mean they're rich people spending their own money. They're out there fundraising as well. They're spending other people's money, and they have to deploy it. So they go make promises to people, hey, give me some money, and then I'm going to put it into startups. You don't have to have an investor. You can go build a profitable company and not raise for that investor. So I would say two things. One is when you decide to go raise, you're probably talking to 50, 75, maybe even 100 people. And you have to just run that funnel. You have to identify the people, you have to call the meetings, you have to get to know them, you have to ask them questions. What size checks do you usually write? What type of companies do you like to invest in? Do you like to be the first check, or do you like to follow other checks? We call those lead investors. And then at some point, once you ask them some questions and you go walk in the park and they ask you, sometimes you have to look them in the eye, kind of like I said, and say, okay, it's time. This is the moment. We've walked in the park. I want you as an investor. I think you're going to be a great investor for me. And I kind of know that you write $100,000 checks. I'm now asking. Here we are. I'm asking you for $100,000. And I need to know if you're going to invest. And if they're like, oh, let's go do some more walks in the park, then maybe it's time to walk away from that. You have to ask the specific question. And if you're not liking where the answer's going, it's probably not going to get better.
Yeah, amongst my founder friends, they're saying investors is like being on Tinder, you gotta keep swiping, keep stuff, but sometimes they ghost you, no matter how much follow-up you do. But I do want to open it up to questions, because I've been asking them, but we do want to hear from you guys. Is there anybody else that would like to ask any questions to Nate and Haley?
Where do you guys meet investors? Where Where do you,
Great
where do you
question.
get them? And how do you, once you meet them, and then how do you actually get them to talk to you?
So I should have explained. In my role, I'm doing a lot of the same thing as founders are. I'm reaching out to a lot of investors because the huge part of my job is making introductions for founders to investors. So I'm working on building those relationships myself. There are, of course, plenty of events around town and more regionally and nationally where investors can be found, including events like demo days and networking events, tech and venture events. Venture Atlanta is a great one here in the Southeast. But the vast majority of the relationships that I've built with investors are from learning some information about them from their website or other information I can find, reaching out to them about something specific that they have done and why I am interested, and requesting a time to get to know them and setting up a call. So it is very one-to-one, building those one-on-one relationships with each person. And I mean, you can obviously find a lot of that information just online, search, Alabama or Southeast venture capitalists or VC firms or what have you, and you can find those and dig in there. Once you have made those initial contacts, keeping that relationship warm is really important so they don't forget about you, because to Nate's point, they need you, but they are getting so many reach outs or emails or opportunities a day that you staying top of mind gives you an advantage, as when they are ready to deploy that capital, they remember that you are someone that they wanted to keep up with. So sending them regular updates of what you're doing and the progress you're making reminders for yourself to follow up and touch base with them and see how things are going. And to the point of getting to the ask of, are you going to invest or not? And not necessarily them leading you on forever. Ask, what would it take? I know I might be too early now, or whatever the situation. What do you want to see to make that decision? Not that if you hit that and check that box, they will ultimately invest at that point, because they are weighing you against every other investment opportunity that they have at that point in time, which may change. But then you have set a target of what you know that they want to see, and whether they pan out or not, hopefully that will position you well for other investors as well. So understanding what they're looking for and keeping in touch as you're moving toward those metrics.
Yeah, I don't know. If you don't follow up.
I got a different one, but go ahead and ask
Okay,
yours.
appreciate it. So in terms of like investors getting their money back, whether it's VC or angel investor, what's that time frame? So is it just generally going to exit, like, if someone acquires a company, then, we give them that equity? Or like, do they expect something, by quarter, or, like what's the expectation?
It's different for angels and VCs. So angel, wealthy individual that's giving you some of their money, investing some of their, I say give, investing some of their money. The relationship they have with you is usually looks like more of a partnership where you're all, having lunch and figuring it out together, if they're participating at all. The expectations regarding a return are different. VC though, once you accept venture capital, your trajectory of your company has changed. You are either going to fail or you're going to succeed, but the in-between, where you kind of just like mess around with the business at a kind of a medium pace for decades, a lifestyle company, like, not okay. And so VCs are going to want a return, or they're going to want a conclusion to your story. Usually when they raise a fund, they're saying 7 years, 7 to 10 years. And so they expect when they invest in you that 7 to 10 years down the road, we're going to know whether your thing worked or whether it didn't work. And I would think that's what you would want as well. Like, you want to get to the bottom of whether this idea you had was everything that you thought it would be. 7 to 10 years though with a VC.
And most of the time, it will be something like an acquisition. Another company will buy your company. Some investors will have different outcomes that they will find valuable as well. They might have their equity bought out by another investor, some different things. But again, knowing that about your investors and knowing what their goals are and at what timeline is something you should definitely know before entering that relationship. Another thing, to Nate's point of the 7 to 10 years, where they are in that fund also matters. So if it's the first year that they're writing checks and they have a 10-year fund, they might want you to pay that back sometime in the next 10 years, maybe 7 to 10 years. If they usually are deploying funds the first half of that fund, which is 10 years, so the first 5 years. If they're investing in you at year 5, that leaves them 5 more years until they're expected to return their funds to their investors. So they may have a tighter timeline of, okay, we're seeing you closer to exit than who we invested in 5 years ago so that we can see that return. So again, all of these factors that each investor is evaluating as they're making their decisions are helpful for you to have in mind.
And you're allowed to ask them that.
Yes.
I was just about to ask.
Hey, what size fund did you raise? Hey, where are you at in the deployment of those funds? When might you expect me to produce a return? Like all those questions, 100% inbounds. And I'll say this really quickly to Matt's question about where do you find investors. This is a place where programs that Haley and I know Matt. So Matt is, welcome Matt, the managing director of Techstars Energy Tech. And so he is now making the energy tech investments that I made over the last 3 years. He and Rae'Mah are now running that program. The way Techstars works, good job guys. The way Techstars works is we leave there's no negotiating. We'll invest $120,000 to very early stage tech companies for 8% or so of your company. We don't negotiate, that's just what we do. And one of the things that an accelerator offers for 13 weeks, our model is we make the investment and then we hang out with you for 13 weeks. So starting in September, the investments that Matt and Rae'Mah make are going to go hang out with them downtown in Birmingham. And during that time, they get lots of coaching, they get access to lots of resources, they get access to this massive network that Techstars has been building over the last 15 years, and part of that network are these investors. So if you aren't sure where to find investors, a program like Generator, a program like Techstars might help you get better access to investors and be something you would look at.
Crazy that Matt was the one that asked, where do you meet these investors? And he's the investor in the room.
I got another question for you guys. You talked a little bit about cap table, which is part of we call it diligence process, but once an investor says, hey, I'm ready to write a check, like what happens then? Do they just cut a check? Like, is there paperwork? Is it an attorney? Like, what do you do?
Yes.
Yeah.
Those things. It will depend on the investor and the stage. At the very early stages where I tend to operate, the due diligence, that process where they're making sure they have all the right information that confirms what you have told them, so they will write the check, is usually lighter than it might be once you have revenue or more customers or what that may be. But the few things that any investor is likely going to want to see at these early stages are your basic core foundational documents of your incorporation documents, your founder's agreement. So if there's more than one founder, who has what amount of equity, what have you agreed to in that? Any intellectual property assignments. So if you have any patents or other intellectual property, how is that protected, and who is it assigned to? Particularly if there's a technology coming out of a university relationship, there may be IP owned by the institution, and knowing how much of the IP is actually owned by the company is important. All of those things. Beyond that, oftentimes you will have some early customers and revenue, and so verifying, oftentimes it might be calling a customer and hearing what their experience is like, why this solution is something that they've chosen, talking to other people in the industry about the type of solution that you have and why it could be a fit or what questions they would have. Financial statements, so you might not have a whole lot of financial history, but seeing what is that month over month spend, how much in total you're out of money, all of those sort of things. Almost always, I think they'll do background checks on the founders. That's something we typically do. Again, not looking for general things, but specifically any business or financial related things on your background that would lead to suggest you might not be the best investment in terms of giving or investing dollars. Once all of that is written, yes, lawyers will be a part of kind of verifying all of this in the back and forth. And that's wrapped up to satisfaction. They ask for your wire information and wire that to your bank account, and you're off to go.
One thing I would add really quickly, at the very earliest of stages, it really is as simple as like, hey, Matt, would you like to invest? And he's like, I guess. And then he writes me a check and we sign like a 3-page document. There's one that's really good. It's called a SAFE that often gets used, and it's available for free online. You don't need the lawyers, and like an individual can just invest some money in you and get a small amount of equity in return. Once you get down the road a little bit, typically raising money looks like, it's called a round. which means multiple. If you're aiming to raise $2 million, that won't be one person usually writing you $2 million or one firm. Usually the 3, 4, 5, 10 individuals and venture capitalists and firms will write that check. That comes together all at once. And so that round, it's like buying a house. It's called a closing. Get the lawyers involved, sign a bunch of paperwork, everybody gets together. It used to be at the law firm, now it's all done usually just, over FedEx and DocuSign. It all happens at once. So you round everybody up, you set a closing date, like buying property, then you show up and the lawyers all sign it, and then you wake up the next morning and there's $2 million in your bank account. That's exactly how it works.
Any final last
And
questions?
how long does that whole process take?
Well, if you just decided tomorrow, hey, and you're a startup, properly positioned, and you want to go raise $2 million, you should expect 3 to 6 months, 100 meetings, and then ultimately 3 to 6 months down the road, hopefully you all show up at the lawyer's office or on the DocuSign and you close the deal and you have $2 million in the bank. 3 to 6 months, 100 meetings is kind of, a little bit off a napkin.
Do you have one more question?
Yes, so I remember you saying that you guys do your due diligence on the founders. How important does your personal finances play? Like, say if someone had like a considerable amount of student loans or like personal debt, how important is that?
Some investors might ask, some might run a credit check, some might do a background check on you. Typically though, because you're not putting any of when you go raise venture capital or you raise angel money, whatever, you're not putting your personal assets at risk. You don't have to sign a personal guarantee where they can come collect on you if the business fails. The business fails, you just walk away and the investors lose their money. So something like your credit is important, but because you're not personally on the hook, it's a little less important. I typically, in angel investments I've made, I haven't run credit checks on people, but some probably do. I don't know. Do you guys?
We don't do credit checks, but we do background checks. And again, things like loans, debt, I don't think any of that would raise any type of red flag whatsoever. The big thing is, have you committed securities fraud? Have you misappropriated people's investments before? And you'll be surprised we do find that in background checks with folks seeking investment. So it's those type of things that would be, you have poorly managed someone else's money before or lied about it and been unethical in some way. Those are the things that are going to raise red flags, not any normal thing of being a human in this world now of having student loans and other debt or things of that nature. Some will have hard lines on other things that may come up on your background check, any type of charges. I think most that I deal with don't really pay that much attention to that. It's really around tax or security fraud related things that may come up.
Quitting your job and starting a company, not good for your credit. Like, you're inherently doing work that is not probably going to help your credit. So if they give you trouble, be like, yeah, this is why my credit's bad, because I've been chasing my entrepreneurial dreams, and learning a lot along the way.
And I think we have one more question.
Yeah, so Nate, you mentioned that you guys do like the 120K in exchange for like roughly 8%.
Yep.
What are you expecting like an entrepreneur's company to be at that time in terms of traction? Because right now, like I have a platform, but it's in like a beta stage, and so I just want to know like.
Yeah, here's another surprise, which is you can truly be at zero. We have invested in multiple companies. There was a really interesting one here in town. Conduit is a company that Ian Hoppy, who was a journalist for AL.com, doing great work for AL.com for years. And he came to me during the first year of our program and said, hey, I want to quit AL.com and do an energy tech company. I'm like, what are you talking about? What do you know about energy tech? He goes, if you invest in me, and I thought he was an extraordinary individual, and he was an amazing journalist, an award-winning journalist, and well-known in the community. And so I believed in him. And he said, if you invest in me into Techstars, I will quit. Like, Techstars will be the thing that causes me to quit my job and chase this dream of mine. And he has now raised millions and millions of dollars, has an office at Innovation Depot, has multiple people on staff. This company is going really well. But I would say the sweet spot is nothing to about $1 million in revenue and maybe 10 or less people in the company.
Having something that demonstrates that someone wants what you're doing, I think that can be the revenue is a great way to show that, but otherwise some demonstration. One, that you're doing something that anyone is willing to pay for, and that you can execute on it. I think to Nate's point at the very beginning, ideas are cheap. There's a lot of ideas out there and being able to execute. And so having a beta is great. Any feedback and iteration that you're able to take and make from that feedback is really helpful to show that you're making progress. Someone's willing to at least give you their time to give you that feedback and experience goes a long way, because that's more than what most people do. Most people stop at the idea. And so the fact that you've gone beyond that is more than you realize.
Awesome. And thank you guys so much. You guys made this such an easy panel because y'all are experts at what you all do. Before we close out, can you tell people how to stay connected with you after today's talk?
Sure. You can find me on LinkedIn, and our website is generator.com. We make it complicated by throwing a number in there. It's GENER. I always have to think about it. Number 8 TOR. So my email is Haley, HALEY @generator.com. And we have programs recruiting throughout the year. So anytime you want to take a look at that, you can go to generator.com/apply, and it has all of our currently recruiting programs open.
Yeah, techstars.com, no numbers, it's just Techstars. Sorry, Haley. Nate.Schmidt @techstars.com. I'm
STARS.
TECHSTARS. Yep, Techstars. But just my name at techstars.com, Nate.Schmidt @techstars.com.
And crazy to know we got 3 Techstars employees in the room. That's crazy. There's a little triangle right here. So if at any point you want to start an energy company, just Google Techstars Alabama Energy Tech.